Good evening, everyone. My name is Bill Sosler. I'm the Director and Senior Wealth Advisor at Mariner Wealth Advisors. I'd like to welcome all of you who came to this event this evening. It is great to see all of you in person. It has been over 2.5 years since we have done a client event in person, and we hope to be doing many events like this over the next few months and the next few years. I would also like to welcome our participants and attendees online. If there is one positive to come from the pandemic, it is that our clientele has become much more comfortable around technology like Zoom, which enables us to bring you this evening's program. For those of you joining us online today, I would like to remind you that there is a link in the chat section that will have tonight's slides. So if you pull that up, you can click on that link and you should be able to follow along with the presentation. Now, it is my honor to introduce tonight's speaker, William Greiner. As the Chief Economist of Mariner Wealth Advisors, Bill drives the economic and capital markets outlook for the firm, and he supports the investment team with tactical asset allocation decisions. His capital markets and investment experience spans nearly 40 years. Prior to joining Mariner, Bill was Chief Investment Officer and President of Scout Investments, where he was directly responsible for the Scout Investments global equity investment process. Bill started with Scout's parent company, UMB, in 1999. During his time with UMB, he was the Chief Investment Officer of UMB Bank and was responsible for all UMB portfolio managers. He also served as chairman of the UMB Asset Allocation and Large Cap Equity Strategy Committees. Before joining UMB, Bill worked for Northern Trust in Chicago. Bill has a bachelor's degree in economics and finance from Washburn University in Topeka, Kansas, and he's a member of the CFA Institute. As the firm's chief economist and spokesperson, Bill is a very sought-after speaker for his expertise and has appeared on hundreds of local and national business news outlets. He has also been featured in respected financial publications such as Barron's, the Wall Street Journal, and Business Week. So, without further ado, Bill, thanks for coming.
Great, thank you. Appreciate it. Thank you. Thank you very much. Looking around the room this evening, I see some of you all are drinking beer, and it kind of, is this on? Everybody hear me okay? Okay. Some of you are drinking beer, and it kind of reminds me of this story. I'm going to kind of show you my age with this story. Back in the 1960s, there was a pitcher with the New York Yankees by the name of Mel Feeney. Mel was a very good pitcher. He was up for the Cy Young Award. One year and struck out, or he won a lot of games. He struck out a lot of batters and so on and so forth. Mel then ran into some real personal problems after that season, and he started drinking a lot and drowning in sorrows and so on and so forth. And the next year he didn't pitch for the Dodgers. Really struggled. And so the Yankee management went to him and said, Mel, you got to get your act together. They said, you're going to start the next game, and if you don't pitch all that well, we're going to send you down to the minors. Well, of course, Mel got all worried about this and got upset. Went out the night before the game. He drank a bunch of beer, a whole lot of beer. Next day, he goes to the game, and he walks the first 6 batters at bat. Management comes out to the mound and say, Mel, you're through. Go pack your bags. After the game, the opposing team were there in their locker room, and they were talking about the game and so on and so forth. And one of the guys brought forward and said, whatever happened to Mel Feeney? He was in a great year last year. Then he walked 6 of us in a row today. He's just not pitching well at all. And another guy said, well, I understand that he went out and he drank a bunch of beer last night and got drunk, And so the other guy says, oh, so it was the beer that made Mel Feeney walk us. Thank you. You like that? If you understand that joke, you're like me, probably well into your 60s, if not a little older than that. It's the beer that made Milwaukee famous. It used to be a byline back in those days. But at any rate, when I was hired at Mariner back in 2012, Marty Bicknell, the owner of the firm, told me, he said, Bill, you're going to be the oldest person on my staff. And I told him, Marty, I'm going to be the most experienced person on your staff. So anyhow, I come to you tonight from that kind of angle of being one of the more experienced people within the firm. Been through a lot of cycles, got into this business back in the late 1970s. So before what we're looking at right now, I experienced from a professional standpoint another inflationary environment an environment of high level of stagflation pressure. So I'm talking to you tonight about these issues with some degree of relevance from the standpoint of what we all, many of us anyhow, remember from the 1970s and early 1980s, which to a certain degree resembles some of the problems and pressures we're all facing today in the markets. So that being said, in front of you, I don't want you to start rifling through papers or anything like that, but in front of you is a chart pack and some things on some information regarding our outlook. And I'm going to go ahead and rifle through the pages. Beginning of this year, here we go. Beginning of this year, our main outlook, we were calling for stagflation to be an issue. We were also suggesting if we don't see stagflation as an issue, we're probably going to see a soft landing. And at that time, people were talking about, is the Fed going to be able to engineer a soft landing in the economy, or is it going to be a hard landing? And what was meant here about this whole issue is, you remember last year how high GDP growth was in 2021? It was approaching 6%. And put that in perspective, going back since the end of World War II, the average GDP growth rate in the US has been 3.2% a year. So last year, the economy was growing, the rate of growth was almost twice what it normally is. We were dealing with a hot economy, and the Fed was looking at a hot inflation profile also. And they're trying to figure out ways to bring that down, to basically land the economy down into a more sustainable level. So at the beginning of this year, people are talking about, are we going to see a hard landing or are we going to see a soft landing? And beginning of this year, we didn't know, nobody really knew exactly what that was going to look like. Now we're all understanding what that's more going to look like. And over that entire period of time, I've been talking about stagflation. Because I remember stagflation, like many of you do, from the 1970s and early 1980s, when inflation was running double digit, 10% plus, and the economy was going through two different and distinct recessionary environments, one in 1980 and the second in the first half of 1982, where the economy basically was in recession, out of recession, in recession, so on and so forth. So the economy was very, very flat on its back, but inflation was running close to 10%. And of course, what happened then was the Federal Reserve stepped up. Paul Volcker said, we've had enough of this, and Ron Reagan said, we've had enough of this, and they threw the economy into recession by driving interest rates up. Did anybody remember how high federal funds, the short-term interest rates got back in those days? Anybody remember the number? 20%, 2-0. There was one rate increase that occurred during like an overnight rate increase that occurred away from a Fed funds meeting. The Fed didn't even meet, and Paul Volcker raised rates by 2% in one fell swoop. We're at 1.6 today, total, 1.6. He raised rates by 2% one night. All right, that's the kind of rate increase that was needed at that time to choke inflation back down. We're dealing with a high inflation rate, a very low, stagnant overall economic environment. So you have stagflation, stagnant growth, high inflation, stagflation. The good news is about stagflation is, and a buddy of mine that I used to work with at Northern, Bob Dealey, he and I were talking about this earlier this year. He said, Bill, you need to remember back in those days and also now, that inflation gives way to stag. Eventually, this cycle that we're in, this stagflation environment, inflation is temporary, and what drives it to the downside is stagnation. So the question then comes down again to, are we going to see a soft landing in the economy, stay out of recession, or are we going to have a hard landing, where the Fed basically drives the economy into recession to try to squeeze the economy so hard that inflation basically just disappears because final demand growth rates slow down to almost nothing. So that's the question we're all wrestling with right now, as the markets are wrestling with that question too. Because if you look at bear markets like we're going through right now in the equities, bear markets that are associated with recessions tend to be more vicious. They tend to last longer than those that aren't associated with recessions. So this is a very meaningful question. I think most investors, at least over short periods of time, need to be asking themselves. Stagflation. We think that there's a 50% probability that the main core economic event for this year is not going to be recession. It's not going to be a soft landing. It's going to be the continuation of stagflation. Our outlook is calling for inflation to be about 6% by the end of this year. Right now, we're about 8.5 or 8.6, depending on how you calculate the numbers. So we think by the end of this year, in the next few months, we're going to start to see a certain degree of softening in inflation, but at 6%, it's still going to be a pretty high number in relation to where we normally see inflation. I'll throw this number out also. Now that I threw out the numbers since the end of World War II, our average GDP growth rate has been 3.2. Any guesses on what our average inflation rate? And Mariner people, you know what it is because I've talked about this already. But non-Mariner folks, Mariner clients, do you have any idea what inflation has been on average since the end of World War II in the United States? 5. Good guess.
3.
Pardon? 3. Good guess. Very, very close. 3.7. 3.7 is the average. That's the big, the big inflation rates we saw in the late 1970s, early 80s, and also the disinflationary and deflationary period we just came through, also with the low inflation profile of much of the 1950s. 3.7. So if I tell you that going forward, our outlook, our core outlook is calling for inflation over the long run to be at 3.0, a lot of the young people in our firm say, oh my God, that's terrible, it's so high. Well, it's not really high. It's actually lower than it has been on average for the last 80-year period of time. And our economy's done extraordinarily well during that period of time. So I'm suggesting that even if we do see a 3% inflation profile on a sustained basis over the longer term in the US, coming out of this environment we're in right now, it shouldn't really be stunning, and it shouldn't be particularly disruptive to people. Now, the process of getting there might be a whole different story, but once we do get there, if that number is rational, and I can give you the reasons why I feel that number is fairly valid, it shouldn't be all that disruptive, and it should foster a good overall economic environment with strong top line and bottom line growth rates for corporate America. Let me see where I'm at right now. I just probably got a little bit ahead of myself. The consensus view, our outlook for GDP growth this year is 2.5, down from 5.8 last year. So we think the economy is slowing, and it's slowing very, very quickly. But we think by the end of the year, we're probably going to be looking at somewhere around 2.5% overall GDP growth, again, compared to 3.2, which is our normal number we've had for the last number of decades. So slower growth than normal. Inflation of 6 versus 3.7, which is what we normally see. So higher inflation than normal. Consequently, stagflation, which is what we're dealing with right now. What's going to continue to be the cooling drivers along with inflation itself being somewhat of a cooling driver to overall economic growth? One would be the fact that the government is going to probably run a deficit this year of about $2 trillion. That's down from $2.8 trillion last year. So while $2 trillion is serious money, obviously, it's coming down as compared to what we were dealing with last year as far as the deficit is concerned. So government spending, while spending itself is going to remain relatively robust, the actual deficit number is probably going to be coming down to one degree or the other. Fed to tighten monetary policy. Of course, they're tightening monetary policy. They've raised interest rates now. The Fed funds rate is about 1.6, 1.65, up from basically 0% this time last year when they were saying, oh, it's all transitory, don't worry about it, pay no attention to the man behind the curtain. Remember what movie that phrase came from? Wizard of Oz. Here you go. Yeah, I like that. Pay no attention to the man behind the curtain. Anyhow, the Fed is tightening monetary policy. It's not just Fed funds are going up in yield at 1.6%. And by the way, we think that number is going to be close to 3 by the end of this year. But 1.6% this year, right now. They've also kicked off quantitative tightening. And without getting too technical about this, the Fed, during the COVID recession and during the financial recession we saw back in 2008, 2009, took on a lot of, they basically financed government spending over that period of time by buying literally trillions of dollars of government debt and putting it on their own balance sheet. And how they paid for that basically is they just printed the money, is how they paid for that debt. So they basically printed the money. They did it through computer entry, but it's still, in essence, printed money. Now what they've done, they started to reverse that process. They're letting bonds run off their balance sheet at the tune of $45 billion per month. So it's 30 days, it's about $1.5 billion of bonds they're letting run off their balance sheet daily. All right, and they're not replacing them. As those bonds mature, they're not replacing them. And what are they doing? So the Treasury has to send cash to the Fed to pay for those maturing bonds. So what's the Fed doing with that cash? They're burning it. Literally, well, not burning literally, but they're figuratively, from the computer standpoint, it just goes poof. That cash disappears. Entity at M2, which is a measure of money supply in the country, last month went down from the month before. And that's a sign of this Fed is really starting to squeeze things. When money supply itself actually contracts and when they start basically burning cash to try to reduce overall money in circulation. Continuing COVID problems really lowered this past first quarter GDP growth rate, along with inventory builds. The ISM peaked, and the Purchasing Managers Index peaked in March 2021. Since then, it's been coming down very, very slowly and gradually. But the decrease we're seeing in manufacturers and purchasing managers' activity on the corporate side is starting to weigh on overall economic growth and is starting to slow things down. Stock market decline has added to growth softening through the wealth effects, what's called the wealth effects event. As people become poorer, they spend less money. And as people spend less money, they tend to drive overall economic activity to the downside, obviously. Lastly, housing starts now are down from last year. So you're starting to show up in housing starts activity as far as the slowing in the economy. The other thing that I'd like to point out as far as what's really driving the economy to slow as far as GDP growth is concerned, if you look at the people that are in the bottom half of income earners in the United States, the average household has household income of about $86,000 in the United States. That's not the average wage, but that's the average household income is about $86K. And people that are at a lower level than that as far as income is concerned, a bigger portion of their income goes towards housing, it goes towards food, it goes towards gasoline or driving their cars, and it goes for utility bills, those four major items. Barron's Magazine calculated what they call their core inflation rate. Those four items, remember I said inflation is running about 8.5% right now. Those four items over the last 12 months, try 17%. 17%. So you have people out there that are making the $15 an hour, that are making less money than the average person in the United States, where a big chunk of their day-to-day livelihood is going to cover those four items. They're paying 17% more today for those items than they did this time last year. So those people, if you're seeing the results, for example, in Walmart and Target, Walmart announced that as far as their store traffic is concerned, people are spending more money in the grocery aisles now as compared to they did last year because of inflation, and less in the general merchandise aisles because they don't have the money. And if they are spending the money, they very well may be using debt or dipping into savings for general merchandise now. So this is all leading into not necessarily a really bad situation, but it's leading into a slowing overall economic environment. So now you can see the slowing in the overall economy is due to many factors that are kind of working together right now. Therein lies the potential for a hard landing. Let me go to the next page here on this piece. Talk about inflation for a second. I think I've already covered a lot of this. I did. So let's talk about the next possible scenario. Well, let's not do that. I'm going to talk about, instead of the next possible scenario, I'm going to talk about the soft landing concept. Beginning of this year, we highlighted 4 or 5 things that needed to happen for the soft landing to actually occur. And you can start thinking about whether these things are happening or not. Number 1, the Fed activity proved successful in cooling overall economic growth, dampening overall inflationary impact more quickly than currently anticipated. And of course, that's not happening. Inflation continues to print higher and higher numbers. Labor productivity gains accelerate, with productivity gains offsetting rising labor costs. Productivity is down 7% this year as compared to this time last year. And it's not going up, it's going down. Job market remains robust, helping drive higher levels of consumer confidence. Consumer confidence now is the lowest it's been in about 5 or 6 years. Investment spending ramps upwards, driving virtuous spending productivity cycle. That's happening. Investment spending is pushing to the upside. Cap spending is pushing up pretty hard. So that's one bullet point out of 4 so far that seems to be working. Fed finds it appropriate to soften their rate increase plans, bringing 10-year Treasury yields lower, spurring activity in housing starts. Just the opposite is occurring, as the 10-year yield now is above 3, and 30-year mortgages now are tickling 6%, and housing starts are down from this time last year. Ukraine war ends, helping drive commodity prices lower. Well, of course, just the opposite's happened. Ukraine war still is going on, and commodity prices, many of them anyhow, have pushed to the upside until just recently in the last couple of weeks when you're starting to see some of them soften, and soften fairly quickly. Take a look at copper, take a look at lumber. Some of those items are really moving to the downside pretty rapidly right now. And I would suggest that has to do with really the softening overall in the world's economy and not really anything magical one way or the other. So these factors that we highlighted at the first of this year as items that needed to probably happen for us to truly see a soft landing in the economy, where the economy was going to slow to a 3 or 3.5% growth rate, and inflation was going to be well south of 3 by the end of the year, just aren't occurring. So let's turn, and we think that's a 10% probability now of the soft landing somehow happening. But I have to basically give that some credence because it is a possibility. Who knows? So let's turn to the other 40% probability. And the other 40% probability is an outright recession. All right, that we just moved our probability of recession up to 40%. I'm on page number 4, by the way, of your little handouts if you're trying to follow along. We moved recession probability for this year up to 40%, as compared to where we were this time last month, which we were about 30% probability. And what moved us to a 40% number had to do with the Fed's raising interest rates by 75 basis points earlier this month. Recession hard landing possibility building probably as a result of stagflation, as inflation gives way to stag, as I mentioned before. None of the 3 warning signs are currently flashing red. There's 3 signs that I'll talk about and kind of describe to you, and you have these charts in your little package here tonight. One is attempting to flash red. The shape of the yield curve is flashing red. 6-month rate of change, LEI, is still flashing yellow. The PMI indices are in good shape but are deteriorating. So this is a really kind of an interesting bullet point here. I just saw this just earlier this month. The New York Fed, the people that are basically helping engineer a potential soft landing that Chairman Powell continues to talk about, the New York Fed modeling shows possibility of hard landing is now 80% over the next year. So the New York Fed is saying the possibility of recession or extremely low growth rates is about 80% over the next 12-month period of time. So that the people that are suggesting that things are going to be okay are just really aren't kind of talking out the other side of the mouth. So if you take our 40% probability of recession and add in the 50% probability of continued stagflation events, we're suggesting there's a 90% probability we're not going to see a soft landing. We're going to continue to have economic issues we're going to be dealing with for the remainder of this year. So that's the bad news tonight. That's the bad news. And the good news is that we will get through this. And more than likely 2023, at least the second half of 2023, is probably going to turn out to be a pretty decent overall economic environment as we move forward. So why aren't we suggesting we're going to see, why is a recession not our core case? There's 3 indicators that we look at Mariner that historically have given a nice head start to a recession call. The first is what's called the shape of the yield curve. The yield curve is simply time relative to interest rates. And normally speaking, investors, all of us, if we're buying bonds, for example, are going to require higher interest rate the longer term bonds that we're buying. It just makes sense. We're locking our money up for a longer period of time. We deserve to be paid more for that lockup as compared to somebody that's just buying a bond that matures, let's say, in 30 days. All right, so that normally is the case. That normally is the typical shape of a yield curve where short-term rates are lower than long. Prior to each recession we've had since the end of World War II, except the COVID recession, by the way, but every recession we've had since the end of World War II, short-term interest rates are higher than long-term interest rates. And that's because the Fed has been before each recession, has been tightening money supply, as they're doing right now, and they're raising short-term interest rates very, very quickly, as they're doing right now. And they're raising short rates so quickly that short rates become higher than long-term interest rates. So why, fundamentally, economically, does that actually throw the economy into recession? And it has to do with banking, lending activity in general in the economy. Cost of funds, the cost of capital for a bank or any basically lender, it tends to be short-term in nature. They pay short-term interest rates for, let's say, 1 year, 2 year CDs or Fed funds or whatever it is. Their cost of capital tends to be tied in with short-term interest rates. Their revenue they receive is tied in with longer-term interest rates, be it 30-year mortgages or be it, let's say, a 5-year bank loan or whatever it might be. And so when you have a reverse occurring where you have short-term rates higher than long-term interest rates, if a bank basically costs them more money to receive the capital than they're going to get lending the money out, they stop lending money. And when they stop lending money, the economy grinds to a halt. It slows down and basically growth ceases to occur. And that's what happens in recessions. It happens in every recession that I know of. Before every recession is that situation occurs. Where are we at with that relationship today is the 2-year Treasury, a short-term interest rate, is about 10 basis points, 0.1% lower than the 10-year Treasury. So you're still looking, you've had a couple of touch and goes on this issue. In addition to that, Fed funds, and Fed funds, of course, being overnight lending between banks, Fed funds are at 1.6, whereas the long-term 10-year Treasury is at 3.2. And normally speaking, before every recession, Fed funds trades above the 10-year Treasury. So we're away from that right now. That gives us one reason why we're not calling that, yes, indeed, we're going to see a recession in the next quarter or two. That relationship that normally happens prior to the start of a recession is not yet occurring. The second reason we're suggesting we're not seeing a recession on the immediate horizon is the 6-month rate of change of the leading economic indicator index. And there's a mouthful of stuff there. Leading economic indicator index comes out every month, and the conference board produces this material, and it says, here's the 10 indicators that are going to tell us how the economy is going to be growing over the next 6-month period of time. Is growth going to be accelerating or decelerating? What does it all look like? And that number is okay. I mean, it's not tremendously predictive, but what is predictive is what does that number look like today as compared to what it looked like 6 months ago? And if that number is down a lot net today as compared to where it was 6 months ago, each time that number goes down 3%, within a year, we're in recession, bar none. There's a 100% track record, a positive track record with that indicator. Right now, that number has been going down. It's now negative. It's negative 0.4% as of the run that the conference board came out with about 2 or 3 weeks ago. So it's going in the wrong direction. It's going down very quickly, but it's not yet at negative 3.0%. Believe me, I'm watching that number very, very closely right now. The third factor we look at is the Purchasing Manager Index. And I already kind of made reference to that earlier. The PMI index on both manufacturing and services. If the reading is less than 50, a reading of 50, and under suggests contraction. The businesses have stopped ordering stuff. They've stopped building inventory. They're concerned about things, and so order rates are really slowing very, very quickly at business levels. Right now, those numbers are still above 50, but they're down hard from where they were this time last year. So our 3 indicators are mainly flashing yellow right now, suggesting that yes, indeed, there may be a recession out there sometime in the next 3, 6, 12-month period of time, but the way that the evidence still suggests that we're a ways away from that actually occurring. So our number one probability again this year is a continuation of the stagflation environment we've been in for the last year or so. We think the probability of a recession sometime starting late this year, early 2023 is probably fairly high. So we're but to make that call, we're not ready to make that call formally yet because we're just not seeing the indicators right now. I'm going to stop here, and I'll be glad to talk about the capital markets, our outlook for the markets, our outlook for earnings, and all those kinds of issues. But I just wanted to kind of open things up for some questions, and I'll try to answer those questions. Should I I guess, yeah, you don't have a question? Okay. Yes, ma'am. I'm sorry?
Who makes more in this economy?
I didn't understand.
Who makes more in this economy?
Okay. The question is, who makes money in this economy?
No one.
Is that right? Who makes money in this economy? Well, businesses make money. Corporate profits are actually up right now as compared to where they were, roughly speaking, this time last year. Those expected growth rates are coming down. Most people think that corporate profits this year are going to be up about 9% as compared to last year by the end of the year. That number is down from 16% expected growth a few months ago, so that number is coming down very quickly. So corporations are making pretty good money, and the growth rate, is still positive. The capital markets, so far this year, the only place really to have made money that I can really point to are commodity prices, and those are starting to soften to a certain degree now. But oil prices continue to be fairly robust. Copper prices year over year are still up, as are a lot of other commodity prices, and they're doing fairly well. Our economy is still in decent shape as compared to many other parts of the world. I'd suggest our economy is in much better shape than the economy in Europe. And the Japanese economy has been on its back for 20 years now. But so I think people are making money. It's just a matter of what making money. They're not necessarily making a lot of money in the capital markets right now, because the capital markets tend to be forward-looking. They tend to look forward as far as what people are concerned about and what might be happening 6, 12 months down the road, not necessarily what may be happening today. Yes, ma'am.
So if you are entering the market today for the first time, where would you place your dollars?
Where would I place?
If you are entering the market for the first time,
Okay.
hypothetically,
Okay.
what would you invest in? Where would you place your money?
Question is, if I was to put money to work for the first time, where would I put money to work in? I would probably, well, first of all, I'd talk to a financial advisor. Of course, you know I'm going to say that, right? And I mean that sincerely. My wife and I use a financial advisor in Kansas City, a young fellow who's younger than both of us, which is probably, at least in my mind, important, because when I pass away, my wife will still have somebody to work with. That's supposed to be funny. I'm an economist. It's about as good as it gets. I think if you have it depends so much on your time horizon and what the money is there to do. I'm not a financial advisor, and probably the proper person to answer this question would be a financial advisor, not really me. From a long-term perspective, I know, looking back in time, the probability of making money in stocks over any 10-year period of time going back to the Great Depression is just about 100%. I can't say that about all asset classes, but I can say that about stocks. I think also, and I'm kind of glad you brought this up, because I've been thinking about this issue obviously quite a bit. Along with stocks, I think if you're looking at a shorter term time horizon, and kind of the punchline that a lot of people really aren't thinking about right now, because they probably just don't have the data at their fingertips. Let's say we go into recession, okay? We go into recession. Let's say that that's the end game here. We do see recession sometime occur going forward over the next year. What should our expectations be? Should we expect another 20, 30% loss in our portfolios? Based on historical standard. I'm just basing all this on historical standard, going back over the last 11 business cycles, going back to the end of World War II. There's a couple of truisms about recessions. Recessions on average last 11 months. That's how long they last. They're not endless events. This recession we saw back in 2008 and 2009 was a humdinger. It was really deep and really long. All right, and it was unusual in that its severity, and it's what I call a balance sheet recession. That was a recession that was driven by excess debt that had been created within the consumer, within businesses, within the banking system. They all needed to be washed out, and that washout process, that debt washout process, means a lot of defaults, a lot of bankruptcies and all that kind of thing. You go through that, the economy is going to really struggle for a long period of time, and the market's going to swoon like the market swooned back in 08 and 09 by 50 or 60% to the downside. That's a balance sheet recession. We have those every few decades. Those are really, really deep. Most of the recessions we have in this country are what I call income statement recessions, and not balance sheet, but income statement recessions. Profitability gets challenged. Interest rates, the cost of capital pushes to the upside for some particular reason or the other. Commodity prices and labor costs might push to the upside for one reason or the other. Does it sound familiar? It's basically what we're dealing with right now. Those are all items that affect income statements. They don't affect the companies or your personal balance sheet. They affect an income statement. And those income statement recessions tend to be solved a lot easier than balance sheet recessions. So recessions last an average 11 months. We go back in time and we look at another truism is that during recessions, interest rates decline. Every time, from the start to the end of the recession, interest rates go down. Because eventually the Fed gets religion and they stop raising interest rates and they start cutting interest rates during a recession. All right, and if you look at each recession on average, the 10-year Treasury has declined in yield by 1.11%, by 111 basis points during the recession. All right, the 10-year Treasury right now is 3.25 or 3.2% yield. So if a recession started today, which I don't think it has, but if it did start today, by this time, 11 months from today, if history is any kind of guide, the 10-year Treasury ought to be yielding about 2.1%, down from 3.2. Okay. That Treasury over that 12-month period of time, because the price of that bond is going to move in inverse fashion to the interest rates. If interest rates go down, the price of bonds go up. The total return on that bond is going to be 12.6% positive return during the recession. All right. Treasury, or excuse me, the S&P 500. What about it during recessions? Well, let's say the S&P 500 goes down another 12%. Which on top of the move we've already seen on the downside, the 21% we've seen on the downside so far this year, would bring the negative return in the stock market down about 34% from peak. If the market goes down by 12% and that Treasury generates a return of 12.5, a balanced portfolio makes 30 basis points during the recession. You actually make money during the recession. All right, so suggesting that during recession, if you have a balanced approach, where you don't have all your money in stocks, but you also have high quality fixed income assets in your portfolio, the landing you're going to see in the recession, if the recession is like any recession we've had in the past, is going to be fairly soft. The period of maximum risk is the period we just came through. That period before the recession, when the stock market is anticipating the recession and bond prices are declining because the Fed is jacking interest rates to the upside. And that's exactly the environment we've just come through. So I'm suggesting to clients right now, instead of thinking wholesale, going out and liquidating your portfolios is probably the exact wrong time to be doing that, honestly. Yes, sir?
We have a question from what is the main driver of inflation, and can Fed policy alone bring it down to 3%?
Okay, good question. Everybody hear that question? What's the main driver of inflation, and what can the Fed do to try to, or can the Fed themselves mitigate the problem? The answer to the second question is, yeah, I think they can, and the reason they can, I mean, Paul Volcker basically showed that that the Fed is very, very powerful if they want to do that. If they can, and he was primarily responsible for bringing inflation from about 11% down to just about nothing in his policies that he launched in the early 1980s. So I think the Fed is capable, and whether they should or not is a whole different question, but they're very capable of wrestling the inflation animal to the ground themselves. And part of that has to do with what goes on with the fiscal side of the government, at the same time that the government themselves can't do things to try to spur inflation to the upside and soften the blow, as politicians tend to do. What causes inflation? Well, normally speaking, what causes inflation is a mismatch between supply and demand. Where, you know, many of us in this room took an Econ 101 class sometime or the other in your college experience, And you know, when demand rises and supply doesn't, a change in supply or demand goes up and supply stays level, what happens? Well, prices go up. It's pretty simple. Is that to clear the market, prices go up and things are satisfied. Either that or rationing, and rationing is basically just another form of price increase. So normally speaking, that's the start of spurs. There's a imbalance somewhere in the economy that's spurring inflation to the upside, that's spurring a mismatch in supply and demand. And if an econ, maybe 202 days, that's called demand pull, is what that type of inflation is called, demand pull inflation. And demand pull inflation is reasonably easily taken care of. It's taken care of by supplies being pushed to the upside over a period of time through investment and so on and so forth, and trade policies and so on, that kind of thing. And so that can be satisfied fairly quickly. The real risk, the vicious side of inflation, is when you have inflation moving from a demand pull towards what's called a cost push environment, where you have wage costs pushing to the upside that don't go back down. Right? Commodity prices come back down, as we're starting to see in certain areas. Once somebody's making $15 an hour, you're not going to cut their wage to $13 an hour just because you can do it. I mean, that person's going to stay at $15 an hour and continue to go north from there. So a cost push situation is, like we said, tends to turn into a spiral. As businesses' costs go up, they raise their prices. As their prices go up, the people that are buying their goods and services go to their employers and say, I need more income because my stuff is going up. And it tends to cycle. The spiral starts to happen. We're starting to see some of that occur in our economy right now. And it's not gotten out of hand yet, I don't think. Because wage growth rates, for example, earlier this year were running about a 5 to 7% per year number. Those numbers now come back down to about 3.5%. So we're seeing a softening in the growth rate of increased wage demands just in the last month or two. I'm hopeful that those softening wage demands are going to continue to be relatively soft. If that happens, then we're probably not going to see the more vicious side of inflation, that being cost push. Yes, sir.
What's the definition of a hard landing, and how will it affect the stock market?
A hard landing I consider a hard landing is a recession, where GDP growth actually shrinks. National output goes down. And for a period of time, there's a rule of thumb, and I'll just call it that. It is a rule of thumb that a recession is 2 straight quarters back to back of negative GDP growth. That tends to be how things work out. The NBER, National Bureau of Economic Research, are the board that basically calls, yes, we're in recession, no, we're not in recession. They're the people that make that decision. And by their own definition of recession, it's an extended period of time of national output reduction. It's not 2 quarters, but it kind of tends to be that way. We saw negative GDP growth in the first quarter. This quarter that we're in right now, some people have said it's going to be negative also. Consequently, we're going to be in recession. Don't think so. And the reason is the first quarter had some really weird, quirky things. Final demand was actually up for both consumers and businesses during the first quarter. The reason that number was negative during the first quarter had to do with inventory build and had to do with imports versus exports. It was a quirky number that threw us into negative territory during the first quarter. Other questions? Yes, sir.
What is your opinion on cyber currency in general? And is there any place for that to be in an investment portfolio?
Okay, asking about cyber currency. I'm not a cyber currency guy. I don't own any cyber currency myself, so I don't have an axe to grind here. I've been hesitant to recommend putting cyber currency in clients' portfolios. I understand pretty deeply, I think, how governments work and how they try to control, from a macro perspective, how they try to control economics within a society. One of the main tools has to do with monetary policy. And for Bitcoin or whatever coin it might be to become the nation's currency, a main currency within the nation, the Fed is going to have to say, you know what, we're going to give up that power. We're not going to want to try to control the economy any longer. We're just going to let these guys do it. Governments don't like to give up power, plain and simple. I don't care if it's democracy or a communistic state. They don't like to give up power. And so I just don't see that happening freely, frankly. But, it may be a new world. I'm just a recalcitrant, maybe. But I'm hesitant to look at it and think that there's some real value there at this stage. It's just me. We offer alternatives for that for clients. If clients specifically want cybersecurity or cyber currency in their portfolios, we can accommodate that in Mariner. But I don't think we recommend it one way or the other at this stage. Yes, sir. Yeah.
You mentioned that recession typically lasts about 11 months.
Yeah.
What about economic expansion or bull market?
Okay.
How long does that last?
Okay, good question. The question is how long do economic expansions or bull markets run? And historically, 5 years, well, it depends on your time horizon you're looking at. 5 years out of 6 are bull markets where stock prices rise in value. 5 out of 6 years. Historically, the business cycles have lasted longer over the last 20 years than they had for the previous 30 years. Previous 30 years, business cycles were very inventory oriented. Building of inventories and reduction in inventories tended to drive the business cycle. Now it has to do more with money supply and the flow of capital. So the latest 2 or 3 cycles we've seen have been 6 years of expansion followed by 1 year of contraction. Before that, it was about 4 years of expansion followed by 1 year of contraction. So let's call it 5 good years followed by a bad year. This tends to be how the business cycle tends to run. Yeah.
Another web question. What is the role of high energy prices in today's inflation? And will Fed policies be able to counteract this?
Okay, good question. Really good question. What's the role of energy in today's inflation profile? And will the Fed be able to counteract that? Counteract higher energy prices? The number one factor in the computation of the CPI, there's like 25 different broad measurements that the Fed conducts, or I don't think the Fed does this. It's the Census Bureau, I believe, that creates the CPI data. 25 or so factors they list each month when they come out with the CPI. Energy being one major block, and then they broke that down by gasoline and fuel oil and so on and so forth. The number one factor, though, is not energy, it is not food. What's the number one determinant of inflation pressure? Rent. Rent is a bigger weight in that computation than energy and food combined. It's more than 20% of the index. It's a big number. And I think inflation has been understated until just recently, because the rent number has been very, very low. Most of you all live as I do, but you all live in an area where housing values have risen very, very dramatically over the last year or two. And I live in Phoenix, and the same things happen there. That number that the Fed has been using for their rent increase or their housing value increase has been 2.5% now each year for the last 2 years. 2.5% a year. What's this all about? Well, they don't look at housing values when they use that number. They use what's called owner equivalent rent, OER. And what they do is they take a poll, a bunch of people, they poll them and say, okay, if you're going to rent your house, what would you rent it out for? That's what they ask. It's a plain and simple question. Well, you as a homeowner, because you may have a cost to carry, your mortgage is a fixed rate, so you wouldn't necessarily move that up a lot one way or the other on a month-by-month basis, because your cost to carry of that house is going to be the same this month as it was last month. So rent equivalent is pretty flat. Whereas we all know, of course, housing values and the cost of rent and so on have been rising rather dramatically. Just over the last couple of months of those numbers starting to escalate within the Fed's CPI data that they push out, or they utilize, So I would suggest that number is understating inflation, true inflationary pressure. But that has nothing to do with energy prices. I'm going down a rabbit hole right now. Energy prices, the reason I said that is because energy prices aren't the number one driving factor behind inflation profile, inflation pressure. They're down a list of ways. Another big factor has to do with what's called miscellaneous commodity prices. That's a big issue. And one of the factors, and again, is kind of a grab bag of stuff. One of the factors that's in there is used car prices. Used car prices is a non-commodity, is a non-core commodity figure. So at any rate, how does energy figure in? It figures in pretty hard, and it figures in very, very hard for people that make less than $80,000, like I was saying a little earlier in the presentation, because they spend, as a percent of their income, they spend a lot more to go out and fill up their pickup truck as a percent of their income than probably most of us in this room do. I'm sure all of you don't drive pickup trucks. I don't. Oh, my wife drives an Escalade, and this might as well be a pickup truck. Filled that thing up the other day, it was $170. I couldn't believe it. Holy Toledo. Yeah. Can the Fed get a handle on inflation? Yeah, they can. It's not going to be painless, but they can do it. And energy is an issue that comes and goes. One of the reasons that people like me look at core inflation rather than all-in numbers, I look at all-in numbers too, but all-in numbers include food and energy. So if you don't drive a car and you don't eat food, then you need to pay attention to core inflation. That's what a lot of people say. Core inflation tends to act as a magnet, though, over time. Is that you look at core inflation, if the core inflation is moving down or up, then more than likely, after a period of time, after a lag, headline inflation is going to be moving up or down also, because core basically is dragging things either up or down. Core inflation, the PPI, producer price index, consumer price index, and the indicator that the Fed uses, all three of those measures of inflation, the core number over the last 3 months has rolled over, is going down. So that gives me, as an economist, the view that if that relationship stands, that by the end of this year, we're going to see headline inflation coming back down also. That's the reason, one of the main reasons we have a 6% number by the end of this year instead of 8.5% on inflation. Yes, sir?
I kind of have a real estate question. So I always thought of Miami as being I heard it was sort of boom bust in the real estate markets. You have these condo buildings, lots of vacancies, and now, with COVID and these real estate markets, they're all booming, the prices are all booming. Lots of people have been moving into Florida and Miami specifically. Do you think, is there a fundamental shift in a market like this, or will this, again, is it just a cyclical and things may change again? Yeah,
you're hitting really close to home with me also, because as I mentioned earlier, I live in Arizona, and Phoenix is kind of the same way. Our population infusion has been similar to what you've seen here in Miami over the last few years. You guys have zero state tax. We still have state tax, but it's a lot lower than California. Californians love Arizona. Can you hear me okay? There we go, that's better. So we're seeing a lot of people coming in Arizona now. It used to be a deep red state, now it's kind of purple. It's kind of because of all the infusion of people. I'm going down a rabbit hole here. Two things I would suggest, all right? We both live in states that are demographically blessed. All right, we have great weather. You get a lot more rain and humidity than we do, but we get dust storms, and you don't have to worry about those things. But we have great weather, and so you have a lot of retirees, you got a lot of people retiring, coming to retirement age. And the baby boom generation, peak birth rate in the baby boom generation wasn't until 1957. So we're not quite there yet, but we're coming very, very close to that peak year. The point is, there's still going to be more years going forward. We're going to have a lot of people moving south, retiring and moving south, turning 65 and heading for sunnier climes. So I think we have that going for us. The other factor we have going for us is the consumer balance sheet is anywhere near as levered this cycle as compared to 08 and 09. There's a whole different world out there as far as consumer balance sheet. So, I'm not making light of the issue where interest rates aren't important. They're very important obviously for carrying real estate and homes. But we have two factors going for us in your state and my state, along with the lack of debt issue, that I think if we go into recession, we're probably not going to see the severity of downturn in housing values this time around, as we saw back in 08 and 09. Housing values in Arizona, this was before I moved there, but housing values just collapsed there. I think they got soft here, but it was pretty bad. But I don't think we're going to see that this time around. Probably see some degree of decline, but nowhere near as we saw back in 08 and 09. Any other questions? Yeah, oh, here we go.
Another online question.
Yeah.
What is the relationship between recession and bear market?
Okay. Relationship of recession and bear market. The relationship is driven by corporate profits. Recessions, national output declines, shrinks, and corporate profit shrinks. Usually speaking, corporate profits go down during recessions. When corporate profits go down, stock prices go down. It's kind of the way things work in the stock market, and people know that. As far as the timing is concerned, historically, bear markets start about, because of the discounting mechanism of the stock market, stock investors tend to try to look forward 6 or 9 months in advance. Stock prices start to roll over and go down 6 to 9 months before the start of a recession, at least historically. And stock prices bottom when about halfway through the recession. At the depths of the recession is when stock prices bottom. Excuse me. And that's normally accompanied by 2 factors. Factor number 1 is the Fed stops raising interest rates. The Fed raises interest rates going through usually the first 3 to 6 months of a recession. They continue to tighten because it isn't yet plain to them as the nose on their face that we're in recession. So they continue to tighten and tighten and tighten, and it continues to draw the economy down. So when the Fed stops tightening, historically, that's usually a really good indication to think about the idea of starting to back up the truck and buy more stocks. It's when the Fed stops tightening. The other is when the NBER, my fellow economists at the National Bureau of Economic Research, when they call, yes, indeed, we're in recession. Historically, that's normally the bottom of the stock market when that happens. When they recognize we're in recession, it's time to start to back up the truck and add to equities in your portfolio. It sounds counterintuitive, but we economists aren't really bright people. We tend to have a hard time looking beyond the noses in our faces. So that's another joke, by the way. Other questions? These are all good questions, by the way. Very good questions. Are we done? We done? Great. Thanks, everybody. Appreciate your time. Thank you. Yeah, thank you. Appreciate it.
Bill, that was fantastic. I get to hear Bill talk every month on an advisor call, and I learn something new every time I get to hear him speak, and it's great to hear you talk to our clients. And you only get to hear him once, but I can see just looking around the room how much people are learning, and you always bring new knowledge to the advisors when we get to hear you speak every week. So thank you very much for coming to do this for the clients too.
Thank you. Thank you.
I was asked to just come up and to wrap up the program, but to also to expand on one of Bill's answers. So there was a question early in the program about how do I invest now, right? It's been a difficult year in the markets. We're all clients and advisors here, so we know it's difficult to invest in a difficult environment like this. But if you have cash and you're trying to put it to work, because you also know that if you're sitting in cash and the inflation rate's 8% and you're getting 1 or less in the bank, you're really getting a -7. So sitting in cash isn't a great solution either. So what do, right? Buying into the equity markets when they're selling off like they did today, or buying into the bond markets when interest rates are going up, it's difficult. So one of the great things, and one of the reasons we are Mariner, is Mariner's investment team is second to none. And so while I do at my core believe in a diversified investment approach for every client that I work with, and that is really the beginning of how you build an investment strategy for a client to meet their financial goals. Sometimes there are pools of money that need a different strategy. And Mariner has really, really good solutions to be able to enable clients to invest, kind of above and beyond or to the side of their normal, what I call core diversified strategy. One thing we do is cash secured puts, right? So you don't even have to invest your cash. You can, it's pretty technical, and I know you don't want to hear that from me right now at 8:30, but, we have a cash secured put strategy that allows you to have cash and builds an income producing strategy on top of that. Nothing's riskless, but it's a way to start investing money with a certain purpose. Second thing Mariner is really doing an amazing job with is structured notes, right? So on a structured note, we've talked about this for a long time, you might have to give up a little bit of the upside, but you can also cap your downside. And in an environment like this, a lot of people are willing to give up upside to put a floor on the downside. So just wanted to come up and mention a couple of options to expand on Bill's answer to your question earlier in the program. That, look, talk to your advisor. Everybody in this room and online has an advisor. If there is some sort of pool of money you're thinking about investing, but you open up the Wall Street Journal and get scared, there are solutions to these things, and all your advisors are well equipped to answer those questions. So thank you again, Bill, and thank you all for coming.